people see CFP, they probably don't know what it stands for, and they don't really know what you went through and what you learned and what you're able to help people with, and also maybe what you're not allowed or not able to help people with.
Right. And the reason that I, went and got the CFP, the Certified Financial Planner designation, was honestly not so much for the credential, Jack, but it was for, just increasing my knowledge base. There's so much out there, and there's so many financial advisors that, they pass a Series 7 and they're equipped to give financial advice. But I knew there was so much more to financial planning, and really everything that you need to know about financial planning, or every possibility in financial planning that you might run into, that's what the CFP is. So everything regarding estate planning, everything regarding insurance planning and risk management, investment planning, what it means to be truly diversified. At our firm, we work with a lot of higher net worth clients. On one tier, it might be clients with 250K or more in assets up to about $1 million. And then planning kind of changes when you have, maybe over $3 million or so. Really, clients' goals start to change, and you have more of that intricate planning. You put more of an emphasis on like tax planning, estate planning techniques, and more of like trying to optimize the situation and save overall. So yeah, overall, I would recommend any financial advisor pursue the CFP. I don't even know how many hours I put into studying. I mean, it was a solid 6 months of lock the door. No one talks to me for the evening when I get home. I have to give credit to my wife. She put up with this for months, and it's definitely a hard task, but the amount of information that I learned was, invaluable, and I'll use it throughout the rest of my career. So that's kind of what the CFP is, if that makes sense.
Are there any things that people come to you and ask you for help with where you have to like turn them away because you might not, maybe they think you can help them with that, but you can't? Like, are there like certain things with
Yeah.
real estate?
Well, that's a good question. It's funny. I think accountants deal with this a lot too. CPAs, a lot of times people go to a CPA just based on conversations with, tax professionals that I've had locally, and they try to kind of circumvent the legal system. That's not what a CPA is designed to do. They're designed to, legally help you pay the least amount of taxes possible, right? So I would say there's some of that where people try to kind of circumvent the legal system. When you don't claim income, it's kind of tough for me to help you plan. I'm not going to help you plan and, and go around what the law is, but in the, what we can work with legally, that's kind of what I specialize in. And, oftentimes some of these business owners, when they have 1, 2, 3 million in revenue or profit a year, what they come to me for is just kind of to serve as their financial operator, if you will. They just don't have time to deal with financial planning or really defining what their goals are and how to get there and how to invest most efficiently. They can probably certainly figure it out on their own, but they just don't have time to do the research or the planning, right? And they don't have access to a team of professionals, which is also kind of what we do here. And it's the reason that I joined the firm that I'm at. Is it's not just me you work with. So, Jack, a lot of times when you work with a financial advisor, you'll sit down with them and they'll talk to you one-on-one, maybe about goal setting or investing. There's a number of different topics that they can talk about. But oftentimes they'll recommend a couple of investments. They'll put you in there and they'll call you up when they want to make a commission, and they'll say, hey, energy is really booming right now. We should get in that. That's not really what we do here at all. And when you work with a higher net worth client, they understand kind of what we're trying to do. So basically what we do here is, like I said, we have a team of specialists. We typically run actively managed portfolios. Doesn't mean we make trades every day or every week, but as opportunities arise, the fee structure that we have is an ongoing 1% fee a year. And basically people are paying us for that ongoing management. So we don't typically charge commissions. We're not trying to sell people on things. We just manage the portfolio as circumstances change. And to give you an example of that, right now treasury bills alone are paying, I think, over 5.5%. So that would be an opportunity where we'd say, hey, listen, we need to jump on this and capture. I think it's under a month. So you can get a 28-day treasury bill and earn over 5.5% right now. So, that's really interesting. And if we can jump on little and capture little incremental gains for some of these clients, our service essentially pays for itself. So you've got the investment planning, the financial planning, and that's kind of what we do. So we have a team of specialists, and that's kind of how we set ourselves apart from the individual advisor. We're not trying to sell things to clients when they come in. We basically create a plan. We charge an ongoing fee, and that way our interests are aligned. So when an opportunity pops up, we can jump on it and not have to charge them a commission either. So hopefully that makes a little sense.
Yeah, yeah. Well, what would you say is like the number one thing lacking in Americans' financial preparation?
Oh, I would say honestly, it's in a lot of advisors. I do a lot of stuff on Twitter. I have recently, I don't know if you watched the Twitter Spaces thing with DeSantis last night and Musk. Did you listen to that?
I did not, but I've been seeing a lot about it.
I think Twitter is really taking off, and I think it's really the future of not only social media but also like broadcasting in general. I think everything is going to be through platforms like this. And we're seeing the change right now, and I think Elon Musk has done a phenomenal job of that, and I love the guy. But so I'm doing a lot on Twitter, and getting back to your original question, I think the one thing that's missing is, most people don't really have a financial plan. And, part of the problem is everybody's trying to make money. So everybody's pitching a different product, and there's always some kind of catch, right? There's always a cost to do business. So I think that's why, people kind of stray away from that. And the problem is not meeting with someone. The intent is to create a plan on their own and save money by not meeting someone. But then when they don't meet with somebody, not only do they not have professional advice, but then they don't make a plan either, because they either can't follow through with it or don't have the expertise to do so. I think that's the biggest problem is, people just don't really have a plan, and they don't have the expertise to execute a plan. So I think that's the biggest problem. And I would say, the best place to start for people is just by setting a savings rate for yourself. And it was funny, we did a seminar yesterday, and I was talking to an older client who was well into their 70s. And I thought their advice was really interesting. They said, I really look at this very simply, and I have my entire life. Since I started earning an income, I just took it and I looked at it in thirds. So 1/3 of my income would be for saving. Regardless of what it was, I just found a way. I said, this is mandatory. I'm going to treat this as a tax for myself personally. And I'm putting 33% of whatever I make each week or every 2 weeks, putting it in a savings account. And I'm not touching it, and I'm investing it. Then the next third, what I'm doing is I'm designating that part of my paycheck to bills. Usually 1/3 of your paycheck will cover bills. And then the next third I use for spending. So, part of the other problem, Jack, is I think people they really try, they're honest in their efforts. They try to create a good, solid plan. But the problem is they can't execute because it's so complex, right? They have jobs, they have lives, they have kids. And sometimes these plans are so complex that they just give up on it, or they don't have time to execute. So if you can really look at things in simple terms, and if you don't have time to meet with a financial planner, I would just say, use that older gentleman's advice and split your income in thirds, save 1/3 of it, spend the rest on your bills, the next third on bills, and then the rest of it you have to spend freely. But if you follow that strategy, even for 10 years, you're going to be amazed at the result, especially if we see market conditions really improve from here, which I think they're kind of at a low point. So
Are there any other like tools or sources of information you find yourself using frequently?
Yeah, well, we have some financial planning software that we use pretty frequently. eMoney is one of them, and it's kind of specific to financial advisors. But it's really a tool. And there's a ton of information online. I mean, you can research until, you can research endless amounts of hours, and you'll never run out of information to look at online. So, I mean, everything you need is really available on YouTube. But that's the thing is, are you going to make time to look at it all and research it and learn it and then apply it? Right. So that's the main thing.
One of my next bullet points, I know this is kind of specific, but for people that have 401ks, I guess, how do you think about 401ks? And for people that want to get access to those funds before they're 59 and a half, like, how do you kind of like talk them through their options and what they should do?
Yeah, that's a really good question. I think especially right now, like in times of volatility when markets are up and down, people tend to be more concerned about the stock market in general. It's just how it works. But overall, I usually advise clients that if you're putting money in your 401k, you really should be, that should be really your last resort. There are really some ways that you can access it by, moving money around and utilizing different strategies before you're 59 and a half. But that doesn't necessarily mean you should. And if that's really your plan, then you probably shouldn't be putting it into your 401k. There are other methods where, like I said, if you're pulling from your 401k, that's probably a last resort. And I wouldn't, if you're under 59 and a half, I really wouldn't try to do that. Overall, the 401k is designed for after 60 years old, another source of income. So, it's pretty simple. A lot of times with plans, 401k plans that you have with a, work or whatever, they don't have a ton of options. It's usually just, maybe growth, income, conservative, something like that. And I typically advise people, if you truly do have a longer time horizon, then you can be more aggressive. And I would just say invest in growth and, stick with it. But certainly as you near those retirement years where you get closer to 60 and you're ready to pull out, you should be conscious of what you own, and you should make adjustments in that plan and start thinking about how you're going to take income off of that. Because, the last 2 years, the markets have been very volatile. If you would have tried to retire, take March 2020, for an example. If you were going to retire in March of 2020, that was a terrible time to retire and pull stocks out, right? Because you're selling when everything's down 20%. So, when you get closer, it's really important to plan. And that's where the more proactive CFP planning, I think, comes into place when you get older. But mostly I would say for younger people with 401ks, set it up and start contributing and just get something in place. They don't necessarily have a need for that, maybe active management as much or active planning, because they're still kind of building a foundation. But you have to get a foundation in place. And a 401k, like you said, is a phenomenal place to start. So, contribute, get the employer match. A lot of employers match 4, 5, 6%. Make sure you're maxing that out. It's not free money, but essentially it's a pay raise or a bonus. So max that out, and that's really a great place to start for investing. So,
Are there any other underutilized investing vehicles that you see? Like, I don't know. Yeah. Are there any other vehicles that you think are really underutilized by Americans?
well, so and it's funny because a lot of people will confuse like a 401k. Very investors that maybe aren't as savvy think a 401k is an investment. It's like you said, it's a vehicle for investments, but it's not itself, it's not an investment. So obviously there's various levels of sophistication among investors, but some other good vehicles that you can use. So I usually advise for someone really starting out and getting serious about investing, if you have a 401k plan, get the match, man, because that's an automatic 4, 5, 6% of earnings that you're not going to get from the stock market, right? So that's, essentially, like I said, it's free money that if you contribute, you get that. So that's phenomenal place to start. So get the full match. You can contribute more than the actual match itself. So start by getting the full match. Then look at other vehicles. So like a Roth IRA. Currently, you can contribute $6,500 a year if you're under 50, and you can contribute. I believe it's, rules just changed this year, so it's a little more if you're 50. But I would say, put $6,500 into a Roth IRA every year. And basically what a Roth IRA is a vehicle where those assets can grow tax free. So over the life of your Roth IRA, you never have to pay tax on the growth of that. Something else that's interesting, a lot of people think that a Roth IRA is locked up until you're 59 and a half, nearing retirement. It's actually not. And there's some cool new rules with the Roth IRA. You can actually pull out contributions to the Roth IRA at any given point, as long as you're not pulling out earnings. So that's kind of interesting. I often don't advise people to pull out of the Roth IRA, but it's an incentive to say, hey, my money's not locked up forever if I put it in here. Another thing about the Roth IRA is for first-time homeowners, the latest rule that I understand is you can pull both principal and earnings out and apply that to your first-time home purchase. So that's another interesting use of those funds, and it's a opportunity for people to save in a Roth IRA tax-free vehicle also. So definitely the Roth IRA contribution limits, like I said, for under age 50 are $6,500 a year. And then in addition to that, that's when you can go back to your 401k, and there are limits to every plan. So it's important to understand what those limits are, or you're penalized, right? It's also important to understand, like I said, how much you can pull out at a given time, because you have to worry about penalties and taxes. It really depends on your income, whether you contribute to a Roth or a traditional IRA, because when you pull out of a traditional IRA, when you retire, that is taxed at ordinary income. So for example, we're talking about lots of land earlier. It's interesting. I had a client that I spoke with recently, and they asked me about buying a plot of land. They wanted to know if it was a good investment. It's a property in their backyard. It's an adjoining property. And they said they wanted to buy it as an investment with their IRA money. And after we reviewed it, found out it wasn't such a good idea. Why is that? Well, first off, they didn't realize, man, I have a tax liability. If I pull out and buy this lot of land, they're going to buy it for around $40,000. Now that increases their taxable income by $40,000, and it was enough to put them into a new tax bracket. Okay. In addition to that, they're on Social Security. So the more income you have when you're on Social Security, it increases what's called a Medicare copay. It's basically your health insurance when you're older. They found out they're going to be paying a ton more in their Medicare copay, which would decrease their Social Security that they'd also be receiving. So, so that's why I'd say, start with the Roth, that tax-free vehicle. And there's a lot of ins and outs for sure, but definitely just sitting down and having the conversation with the financial advisor to start. Whether you need ongoing advice or not is your decision, but I would say it's just great to sit down with somebody and figure out at least what you need to do to set a foundation. And then if you have questions, obviously that's a great chance to meet with an advisor also.
Okay. I mean, you don't have to give us dollar amounts, but how is your portfolio allocated?
That's a great question. So like I said earlier, we have managed strategies here. Right now, as far as stocks to bonds are concerned, I'm 100% stocks. I'm very bullish in the future of really America, and internationally as well. You would probably know a little better, how international markets have outperformed U.S. markets actually this year, which is why it's important to own some of those international companies as well. But mainly I am invested all in stocks. I have a little bit of cryptocurrency. As an advisor, I can't advise people to buy cryptocurrency. I definitely think there's some potential there though, for the technology. But my time horizon's really long, and I'm invested for the future. And if you're consistently investing for the future, I like to tell people dollar cost averaging is something that I do all the time. Every month I'm putting $500+ in my Roth IRA. I'm putting it in my wife's Roth IRA. So we're maxing out that amount. So at the very least, every year, between the two of us, we put $13,000 into that account. We're both maxing out our 401ks. We're getting the maximum employer match. and it's all going into equity. And you know what? Over time, if you look at history, the stock market does about, nationally in the United States, it does, maybe 10 to 12% on an annual basis. If you're looking at it from a long-term perspective. So that's our goal. We know that if we, constantly contribute to those accounts and don't pay attention to what's going on in the market, on a short-term basis, like what's going on with the debt ceiling right now. We don't really do day trading, nothing with penny stocks. Nvidia yesterday, I do like a daily market minute. You'll probably see it if you go back on my Twitter. Nvidia was up like 20% after hours yesterday. We're not, the kind of people who jump on the single stock bandwagon. We use mutual funds. We're very diversified, but like I said, we're in stocks, and we're really in it until we're ready to retire or even later. So.
You have any, so you mentioned the crypto, do you have any like physical gold, silver, or real estate?
That's a good question. It's funny. When I was really young, I was into collecting coins. I sound like a huge nerd, but I always thought it was interesting, just like the historical value, not even so much the silver or the gold content. I just thought it was really interesting. That's kind of how I got into, being a financial advisor and a money guy, honestly. So I have, maybe a few $1,000s in coins, nothing substantial, but I don't really advise people to invest in gold and silver. And I don't have the numbers in front of me specifically, Jack, but gold as an asset over the past 20 years has been fairly stagnant. It'll oftentimes in time, when we're looking at a period of economic distress, gold maybe performs a little better because people flock to something they can actually hold on to with their hands, like a physical asset that they feel is worth something. But performance over the long run is actually very poor. So, like I said, we're more long-term investors, and we invest in things that are going to make us money in the future by, their output. So, Apple's selling a lot of phones. Amazon does a lot of revenue every day, right? NVIDIA is selling a lot of microchips. McDonald's is flipping a lot of hamburgers. So we want to be involved in the companies that are truly making a profit and that people are paying money every day, to buy product from. So that's kind of my view on things. And that's my stance on gold and silver, really. And another interesting thing, I heard something about Elon Musk say apparently there's an asteroid floating in space that has enough gold to make gold worthless. That if you could actually harvest the gold on this asteroid, it would make gold worthless. So I don't know how close we are to that, but it's something else to think about when you're considering gold as an asset.
Yeah, definitely. I actually heard, this might have been a year ago now, but the technology is getting so good, they also think there might be gold like deep under the sea, and it's not really accessible now. But that could also really tank gold if people got access to that. So yeah, definitely interesting to think about.
Yeah, it's interesting. They're coming up with new ways to natural resources to harvest them. So I live in Florida now, but I'm from North Dakota. Okay. And for a long time, the oil reserves up there were, they knew there was more oil, but they couldn't, I don't know if the right word is refine, they couldn't gain access to any more natural resource of the oil itself, because the tools, the technology that they had just couldn't get to it. Well, now I think, there's an oil boom in North Dakota. It's probably been 5 years now. And Williston is the town out there, absolutely exploded, that whole area of Western North Dakota, because they created new technology to drill not only further into the soil, but also sideways. And the fracking technology just expanded. So, who knows what's going to happen, but I wouldn't doubt that in the next, who knows if they truly do identify gold under the sea. I can't imagine someone's not working on a strategy to try to mine that right now. So it'd be interesting to see what happens.
Yeah. Well, this has been very cool. You talking with us. I've learned a good bit. If you could, I guess, leave the audience with something to take away, something to focus on, or one piece of financial advice, what would you say?
Oh, one piece of financial advice. Well, and actually something that's been floating around a lot on Twitter that I think is interesting. You can only cut your expenses so much. You can
Okay.
increase your income, to an unlimited number, infinity, right? So that's something to think about when you are budgeting. It's pretty easy to get caught in the weeds with what can I slash for, expenses. And if you follow Dave Ramsey, he's kind of a stickler on that stuff. And I don't think a lot of what he says is wrong, but you can get so hyper focused on cutting expenses that you forget, what the true moneymaker is, which is your income, right? So that is unlimited. So always be thinking of ways to increase your income and never lose the spark, never lose the fire. I thought it was interesting. I saw a quote the other day. I think it was from Ben Franklin or someone like that. Who knows if it was actually him? But he said, most people die at age 25. They're just not buried until they're 80, which I thought was really interesting. When you get stuck in a job or something like that and you get married and start having kids, it's, sometimes easy to just lose that fire, right? I think a lot of people have the fire before 25, but it's easy to lose it and kind of forget to be excited about business and entrepreneurship and all that. But don't lose the fire. That's the other thing I would really say. So, and talk to a financial advisor, talk to specialists if you have questions, right? I mean, personally, I'm not a CPA or a tax expert. I know a lot about taxes, but if I have a professional question, I'm going to go ask a CPA. Why would I waste my time, trying to figure out the tax code and waste money and, then do it improperly and be charged penalties? It just doesn't make sense. So, use your resources and don't lose the fire. That would be my advice.
That's great life advice. I couldn't
Yeah.
agree more. Yeah. And where can the audience go to learn more about you and the services you provide?
Yeah, well, you can find me. You can go to our website. I have a website. It's faminvesting.com, faminvesting.com, or just follow me on Twitter. My name is Riley, Riley. My last name is Giauque, Giauque. Yeah, type that in Twitter and send me a follow. I'm also on LinkedIn and Facebook and YouTube as well. Do a daily market update and we have some other cool content on there that your viewers will have to go check out if they have time for sure.
Cool. Awesome.
So
Thanks so much for your time, Riley, and
yeah,
really appreciate the work you do and the information you're spreading.